Hello everyone, welcome to Within the Frame. I'm Kim Bo-kyung. The OECD raised this year's global growth outlook to 2.9%, citing strong improvements in the U.S. offsetting weakness in the Eurozone. Worldwide inflation has been slowly tamed, but the organization still warned of geopolitical risks in the Middle East that pose a significant threat to global activity and inflation rates. In line with such warnings, Federal Reserve Chair Jerome Powell said the central bank was going to carefully proceed with interest rate cuts this year, adding confidence is needed to take such important steps. How is the global economy right now? And with a rate-setting meeting coming up, what should the Bank of Korea's monetary position be? For this, we invite Professor Oh Joon-seok from Sookmyung Business School. Welcome to the show, Professor Oh.
Thank you for having me.
And we also have Trinh Nguyen, senior economist from Natixis. Good to see you again, Trinh.
Thank you for having me.
All right, first question to our Trinh. So first of all, the OECD raised its November forecast by 0.2 percentage point to 2.9% for the global economy. Now, what were the reasons behind such a raise?
First, the U.S. economy continues to surprise on the upside in its resilience. The Fed raised rates from basically 0 to 5.5%. And still, the U.S. economy is very resilient. So if you look at whether or not it's the manufacturing sector or the service sector and jobs, it continue to absorb higher rates quite well. But even so, we think that there is softening to come, and that softening is coming from the fact that the service sector will start to crater, particularly on the weak side of the economy, such as lower income that's having a hard time to access credit, and also for the SME side that's having a harder time accessing credit. And as a result, the increase of job will start to deteriorate. So we think that in the second quarter and in the third quarter, we'll see more softness in the U.S. economy. But for now, it is very strong. U.S. exceptionalism is still here. And as a result, the dollar remains strong because markets expected the U.S. economy to weaken very substantially, but not yet, which means we're not going to get any rate cut in the first quarter, but very likely in the second quarter.
All right, so though something is expected to come, for now, U.S. economy is resilient. I see. Now, Professor Oh, meanwhile, it revised down South Korea's growth outlook to 2.2%. And I hear this is quite the opposite compared to other G20 countries' growth forecasts. Why the fall in the projection?
While the IMF lifts Korea's 2024 economic growth forecast to 2.3%, OECD to grow 2.2% this year, a drop from its previous forecast of 2.3%. The Bank of Korea expects to grow 2.1% this year. Now we have to know why. The OECD did not mention officially its reasoning for a downward revision. The OECD report, however, cited it is considered as Korea's trade-driven economy, the global economy losing momentum. And since the end of last year, the ongoing monetary tightening and structural uncertainties in China. Yes, it's true. And OECD assessed the world has resiliently recovered last month. Such a growth momentum, however, weakened at the end of 2023. I want to add my reasoning for the revision of Korean economy in two respects. First one is heartache would be Red Sea crisis. It is true international trade still remains sluggish this year, but shows a sign of rebound on the back of sales of chips, IT devices, and cars as well. Possible risk factors, geopolitical uncertainty, as you mentioned, could cause a stronger inflation as well as the debt burden caused by high base rate. The Red Sea crisis could put forward the freight shipping rate, insurance fees, and increasing shipping delay, bring negative effects on international trade, definitely. And second, weak domestic demand in Korea. That's a real problem. OECD downward revision, despite the country's export rebound, comes mainly from stagnant private spending and investment in Korea domestically. Retail sales as gauge of private spending fell 1.4% on year last year, and sales of food and other non-durable goods lost ground amid high inflationary pressure. In addition, Korea's manufacturing sector output fell as well as to its lowest level in 25 years in 2023, while sales and investment also tumbled last year amid high interest rates due to inflationary pressure. This may explain why.
I see. So the revision is mainly because of the risks coming from the Red Sea and also the weak domestic demand. Now, we are going to get to those factors, but before that, Trin, I'd like to ask you about the trade. As our Professor Oh already mentioned, South Korea is a trade-driven economy, and the country is currently expecting its economy to recover this year on rising exports. However, given that China is going through an economic slump right now, should we be very much worried about the speed of export recovery?
Absolutely. So we have very strong data for Korea. In January, it rose 18% year on year. But then if you look at Samsung Electronics, it's quite underwhelming. So the worry here is that two things. For China, we're experiencing deflation. In China, today's data show that deflation is quite persistent, which means that China produces more than it demands. So demand in China is very weak and supply is very high. That's very negative for Korea for several reasons. One is that not only do we have a weak demand from China, meaning that they will demand less from Korean exporters, but you also have a situation where they will want to export that outside, right? So which means that Korea not only is not able to export more to China, but also will face more fierce competitions in areas that it wants to excel in, such as intermediates or even in chips. Now, the only positive side to this very weak China story are twofold. One is the weaker the Chinese data is, the very likely and the possibility of policy support is higher. So we expect the much more concerted effort to revive demand in the economy, right? And so we're starting to see a lot of that, such as the 50 basis point triple R cuts, a lot of policy supports recently focusing on the stock market, but increasingly it should also focus on demand side of the equation. For Korea, I think demand from China will increase, but mostly a global trade story, right? It's because of the recovery of the ICT cycle, and China is a very important player in the regional trade supply chain. So already you're seeing shipment from Korea to China increasing in January, and I think that's a trend that's going to increase. So in other words, it's negative, and it's a worry, and it's not just a worry on a cyclical basis. On a structural basis, should China policy continue to be very supply-side driven, particularly supply-side driven on sectors that Korea traditionally excel, such as semiconductor, EVs, and so on and so forth. And that is going to be a big worry. If China does not fix its deflation problem, it cannot reflate its economy, it will mean that Chinese exporters will try to export the deflation elsewhere, and that's a key concern for Korea, which is a big trader.
All right, I see. Quite negative outlook for South Korea's trade industry. Well, we cannot leave out inflation. So, Professor Oh, overall, worldwide inflation seems to have been contained, with Eurozone consumer prices slowing down to 2.8% in January, while the U.S. too has seen consumer prices remain in the 3% range for 7 months since last June. Now, fall in oil prices must have contributed a lot to the fall. Is this right?
Yes. Before talking my comments, I agree with Ms. Nguyen. She mentioned about the supply side. Now, come to the market side from the perspective of Korean economy. As you mentioned, the market side for Korea, luckily, the inflation might be handled in the near future. In the EU, consumer price rose 2.8% on year, marking the first fall below 3% in 6 months. Inflation across the Eurozone fell by more than expected. Consumer price across 20 countries now lowered to 2.4%. In the U.S., inflation has been the Fed's top priority, definitely. The FOMC has raised the interest rate 11 times since March 2022 in an attempt to bring inflation back down to its 2% long-term target. Fed is attempting to navigate a balancing rate to bring down inflation without tipping the U.S. economy into a recession. What's behind the contained inflationary pressure? As you pointed out, one of the major reasons would be falling energy prices and weaker increases in the cost of buying food and beverage, even alcohol and tobacco, capturing headline inflation within striking distance of 2% target rate of European Central Bank and the Fed in the United States altogether. ECB, however, have repeatedly stressed it is too early to declare victory over inflation. As they monitor the potential pressure from wage increases and energy markets, inflation in the U.S. was up 0.3% in December from the previous month. FOMC would indicate interest rate cut would likely be appropriate by the end of 2024. Now the situation of conflicting two sides against each other. Hawkish side is calling for fewer rate cuts in 2024 because inflation could rebound if the Fed eases up its monetary policy again. Dovish side calling for the Fed to cut rates more aggressively, especially if the U.S. consumer spending starts to weaken. It is very sensitive now for monetary policy to keep balance between cooling down inflation and heating up sluggish economic growth.
All right, I see. So inflation pressure quite tamed for now, but early to claim victory. All right. Well, OECD also raised concerns regarding this trend, saying that elevated shipping costs due to ongoing tensions in the Red Sea could add 0.4 percentage points to overall prices after a year. Now, how do you see such a concern?
First, goods inflations have been going down, right? Because, as you know, there's excess supply, not enough demand. So deflationary pressures on goods side. And of course, we have geopolitics becoming a big issue because this means that shipment path from Asia to Europe and vice versa have been seen increase in costs. And so that obviously adds to cost to shipment. But it doesn't really translate to overall inflationary pressure, as I mentioned, because of still deflationary pressure from China as it produces more than it needs and it's going to export that globally. It is going to be a concern if this translates to higher oil prices. Oil prices have moved upward gradually. It's still sub $80 a barrel. But if it moves substantially higher than that towards, say, 100, which isn't our baseline scenario, because if you look at the way the U.S. react to this, it's been very targeted rather than trying to broaden out the conflicts. But should that broaden out, then you can have a very negative effect for Asia, negative effect for Korea, because it's a net importer of oil, and so is Thailand and so many countries. So we wouldn't want that, because then that would translate to other goods, and that's a significant deterioration of the current account as well as translation to households and government balance sheets. Now, we think overall, if you look at inflation, the worry in the developed market is really about service inflation. Goods inflation have been relatively tame, particularly in the U.S. So it's a question of whether or not service inflation will slow. So in the short term, less concerned about goods, but it can potentially blow out if the conflict spiral. For now, our baseline scenario, it doesn't. But that concern continues to be a risk, of course. And that's one of the reasons why we think central banks will take a very cautious approach. Inflation has come down globally. But given the fact that they have been wrong before, they want to make sure that it continues to fall within target, particularly service inflation, to then be confident enough to start cutting rate.
All right, I see. Well, as our train already pointed out, the U.S. Fed also held its benchmark lending rate steady for a fourth consecutive time last week, Professor Oh. This, like our train said, it is to carefully proceed with rate cuts, considering the last mile risk, isn't this?
From now on, timing of the policymaking will be very more delicate in modulating the market response and the effect. It's like, we are on a plane, and then landing time is very, very important. It's about to land time. The federal funds target rate has remained at 5.25% to 5.5% since last summer, following 11 increases that began in March 2022. Rate sets a benchmark for everything, from credit card to mortgage, shops, and office rent and auto loans. Fed Chairman Jerome Powell said recently interest rate had peaked and would move lower in coming months, but there is a strain. with inflation continuing to fall and expectation of sustained job and economic growth. This Fed dual target of employment and inflation goals are moving into another equilibrium point, I guess. The labor market shows some sign of coming back into balance after a period of red-hot hiring. Job opening becomes converged into a lower level than before, as wage growth gradually has slowed somewhat. And what changes in the market is demand has returned alongside a steady slowing in price increases. Consumer price index peaked at 9.1% in 2022, but it is now down to 3.4%. And it is still higher than the roughly 2 percentage point of a normal level, but recent progress has been steadier than many had expected. It seems highly likely that the Fed are in no hurry to ease as rapidly as benchmark rate, with further promising inflation data still required to cut the benchmark rate.
All right, I see your point. Well, Trin, staying on the Fed's decision, the chairman, Jerome Powell, said the central bank will move at a considerably slower pace with probably fewer rate cuts than what the market expects, which suggests it is unlikely the FOMC will make its first move in March, as our Professor Oh, to be delicate. But can the current U.S. economy hold up until the Fed makes this decision to cut the rate?
Absolutely. And that's the key problem for emerging markets and the rest of the world, right? Because the U.S. continues to be absorbing the shock, right? This is the tightest cycle since the 1980s, and rates are at 5.5%. And as a result, it basically hoovers capital from the rest of the world. The dollar is very strong. And we do see cracks in the U.S. markets, right? Cracks are very indebted, low growth. Interest rate sensitive sectors like commercial real estate, badly managed regional banks. But overall, it's still too strong. So as a result, the Fed has two mandates. One is employment and one is inflation, and both are still too good for them to cut. So they will have to wait for the cracks to appear, particularly because this is an election year. So they don't want to come across favoring one candidate, particularly the incumbent, to the other. And when we get to March, which is we only have one more data for non-farm payroll, it's not going to crater until then, right? So we need data to weaken materially, and that's not going to happen in first quarter. It's going to happen likely in the second quarter. And as I mentioned, the cracks in the economy in the lower income sector, in the SMEs, and that's going to translate to weakening of consumption and weakening of the labor market. And so we do have to wait still in the meanwhile, and then markets will have to recalibrate the expectations that they have in recent months, and one of the reasons why the dollar rallied quite strongly in the beginning of February and also January, because December was too excessive in euphoria, and then we start the year with very, very, very strong data. So overall, we expect a soft landing in the U.S., meaning that it's going to decelerate in the second quarter. But it is still going to grow enough to give respite to Korea. Interest rates going lower will give the Bank of Korea space to cut. But even though it's going lower, the fact that the ICT cycle is recovering will give support for Korean exporters, right? One of the conundrum the Asians had to bear with is the fact that a very strong U.S. economy in 2023 didn't lead to higher import from the U.S. because they had too much of electronics, the closets were full. So they didn't import. Actually, imports contracted. Imports also contracted from China. Now, if you look at the latest ISM manufacturing, inventories have actually reduced quite substantially, and orders are accelerating. And that's a very positive thing for Asian exporters.
All right, I see. Well, our train already gave us the hint of where BOK should go. But Professor Oh, I'd like to ask you as well. Now, as the Fed has decided to maintain its key interest rate, it won't be easy for the Bank of Korea to consider a rate cut. But what decision might the central bank make during its rate-setting meeting that's scheduled on the 22nd? And in what direction should the policy take?
Yeah. It's very critical time now. So we already know that roughly 2% range of interest rate gap between Korea and the U.S. should be kept, avoiding the risk of capital flight and foreign exchange rate fluctuations. In this respect, the Bank of Korea will never be the first mover, but take the standby mode following the Fed decision and keep monitoring Fed decision process is very important nowadays in a way to respond appropriately to the decision and to stabilize the market reaction as softly as possible. It is expected in tune with the rate cut of the Fed when it happens, might be May or June. The Bank of Korea will follow rate cuts consequently. On the other hand, one thing we have to remember as conditions for economic fundamentals, it is of great importance for Korean economy to boost the domestic demand and investment in the private sector, which might be make the monetary policy make it feasible and then more effective.
All right, we need to boost the domestic demand. All right, I see. Well, thank you for your advice, Professor Oh. Now, I'd like to ask many more questions to our experts, but unfortunately, this is all the time we have for today's edition today. Thank you, Trin and Professor Oh, for your time and insights. We really appreciate it.
Thank you for having me.
Thank you.
Thank you. All right, that's all for Within the Frame tonight. We'll be back on Tuesday with more in-depth stories. Enjoy the Seollal or Lunar New Year's holiday. Until then, goodbye.